Did you know that a huge investment company said that Tesla stock is a buy right now? While many lost trust in the leading EV company as it went through a rough year, others believe that right now is a huge buying opportunity for Tesla stock. You surely would not want to miss this info. After Tesla's tumultuous stock slide in 2022 put shares down nearly 70%, numerous analysts adjusted ratings and price targets in alignment with a global economic decline, as well as questions regarding Tesla CEO Elon Musk's acquisition of Twitter. Despite Tesla stock tumbling throughout last year, some Wall Street analysts are seeing the low share prices as an opportunity. Following a challenging year for Tesla stock, one firm has changed its tune on the automaker's potential, noting that the current buy-in price may be reasonably low. Edward Jones analyst upgraded Tesla to buy from hold, also adding the stock to the firm's focus list in a note to clients a couple of days ago. Edward D. Jones & Co. LP, simplified as Edward Jones, is a financial services firm headquartered in St. Louis, Missouri, United States. Edward Jones offers a personal approach to investing with 18,000 financial advisors ready to support client needs. Tesla was upgraded from a hold to a buy rating by Edward Jones analyst Jeff Window earlier this month, as reported by CNBC. The news comes as Tesla's stock has fallen significantly in recent months, making the company's share price look appealing to previously skeptical analysts like Window. The analyst commented, "Tesla stock price has declined significantly over the past year due to concerns of slowing economic growth and Elon Musk's time spent managing Twitter. While slowing economic growth could pressure near-term auto sales, we believe the electric vehicle market will continue to expand due to global regulations. Global regulations on emissions and mileage are driving the growth of EVs. While competition is rising, we expect Tesla to continue to have a significant presence in global markets," writes the analysts. On Musk, the analysts believe that while Tesla has a solid management team that can execute the current operational programs, Musk stepping away from Twitter would benefit Tesla. In addition, new products and technologies should improve profitability, they argue. Programs that have software or ongoing subscriptions, such as full self-driving, are especially important for Tesla, as they are expected to be more profitable. Additionally, Tesla is working to improve manufacturing efficiency and reduce costs. Specifically, ongoing design improvements with batteries should reduce cost and help to improve profitability, the analysts added. Window shared their belief that Tesla's new product launches will allow it to take advantage of this expanding market. "In our opinion, the share price of Tesla does not reflect its long-term growth opportunities. Tesla has above-average price movement both up and down relative to the market, due in part to shifts in investor views about the future of the company, which depends on growth in the EV market, Tesla maintaining significant market share in EVs, and the success of new business ventures." In a note to clients, Window described Tesla's stock as looking affordable given the potential for the company's long-term growth. He also said he expects Tesla's full self-driving FSD beta to continue improving, along with the automaker's EV batteries. Additionally, Window pointed out Tesla's plans to launch new products this year, including the upcoming Cybertruck, as well as the potential rollout of an updated Model 3 design later this year. It is worth noting that the Cybertruck is several years late, and the Model 3 project, which has been codenamed Highland, both contribute to potential improvements in Tesla's market position this year as more competition enters the EV sector. While Tesla will not be the first company with an electric truck on the market, the Cybertruck is likely one of the most anticipated vehicles in history, with over 1.5 million registered pre-orders. The stock movement this year has been eye-catching, Window admits. However, Tesla maintaining significant market share in EVs and the success of new business ventures is ultimately dependent on investor sentiment. Tesla has above-average price movement both up and down relative to the market, which has been caused by significant shifts in investor views. 2022 has undeniably been a rough year for Tesla, with Tesla stock falling by 65%, exacerbated by rising interest rates, CEO Elon Musk's sale of shares, and concerns over cooling demand. Despite this, the EV sector is expecting to continue growing over the next several years, and some think that Tesla is well positioned to handle incoming competition from other automakers. Musk has also said he won't be selling more Tesla shares for another 18 to 24 months. However, it is worth noting that it wasn't just Tesla that saw stock values slide in the past year. The stock market as a whole declined in 2022, and within the auto sector, every single automaker saw stock prices go down. Major players like General Motors and Ford fell some 40%, and startups like Rivian and Lucid dropped more than 80%. All automakers faced the same headwinds that the broader economy faced: inflation and rising interest rates. They also started 2022 with shortages of parts that kept dealer lots unusually empty and ended the year with sky-high vehicle prices that could be turning away would-be buyers. Overall, U.S. auto sales declined in 2022 to decade lows, according to estimates from Cox Automotive. Still, the Tesla Model Y, the automaker's flagship SUV, beat out the Honda CR-V last year to enter the top 10 best-selling cars in the U.S. The category includes both gas cars and EVs, making a significant milestone for the company's increasingly mainstream appeal. The automaker also opened 2 factories last year, one in Grünheide, Germany and one in Austin, Texas. The plants are expected to continue ramping up Model Y production, and they each reached milestones of a 3,000-unit weekly output in the past few months. With that said, many are thinking, is now the right time to go all in on Tesla stock? Currently trading at $123, Tesla stock has never been this inexpensive. But there are some good reasons for that. Tesla stock had a rough first day of the 2023 trading calendar year, falling 12.2%, but shares were down as much as 15% at one point during the session. The sell-off was largely due to Tesla's disappointing delivery numbers for Q4 2022, which were released on January 2nd when markets were closed. Tesla achieved record deliveries of 1.314 million vehicles in 2022, including 405,278 deliveries in Q4 alone. But many analysts, such as Wedbush Securities' Dan Ives, were expecting a Q4 delivery figure in the range of 415,000 to 420,000. Although Tesla produced 8.5% more vehicles than it delivered for the quarter, it remains to be seen if the gap between production and deliveries was due to decreasing demand or logistics issues. Either way, the lower-than-expected delivery numbers adds yet another cause for concern to a stock that is down 59% in the last 3 months. According to an expert, investors have had high expectations for Tesla over the past 3 years and have assigned it a correspondingly high valuation. But for those that believe the company and EV sector will continue to grow, the 65% drop in the stock price in 2022 provides a compelling opportunity to invest in the industry leader. Investors and Tesla enthusiasts should be aware that Tesla is in a still evolving sector and could disappoint investors in the near term. A case in point was its recently announced fourth quarter vehicle delivery data, whereas the shortfall in deliveries came as demand has been impacted by increasing competition, slowing global economies, and the effects of COVID-19 spreading in China. Still, the company's growth remains strong. Tesla's production increased by 47% in 2022 versus 2021, but deliveries only increased by 40%, leading investors to believe Tesla might not, in fact, meet its previous projections to average 50% growth over the next few years. That said, now seems to be a good time to begin buying or adding to your position. Even if Tesla grows earnings by only 30%, it recently was priced at a price-earnings-to-growth ratio of below 1.0 based on 2023 estimates. Accumulating shares makes sense now for long-term investors, but there may be better prices to add more later. While Tesla stock could well possibly set new all-time highs in the future, the problem with stock prices rising so quickly is that the company has to hit lofty goals to make the valuation reasonable. And as impressive as Tesla's growth has been, a mix of macroeconomic and self-inflicted challenges are making those lofty goals increasingly unlikely. Missing delivery expectation paired with the possibility of a recession adds another layer of issues impacting Tesla. That said, it's impossible to say with any certainty what Tesla's stock, like with any stock, will do in the coming month and/or years. However, Edward Jones analyst Jeff Window's bear-turned-bull mentality balances Tesla's long-term potential with its recent stock woes, resulting in a low buy-in price that could be a major opportunity for investors. Subscribe to Tesla stock right now.